Good morning, good afternoon, or good evening, depending on where you are. Thank you for joining us live for today's MAI webinar, Publishing Finance 101 with Joyce Mae Manalang. Warm greetings from MAI. This is Ramon Rocha. We have a lot of material to cover, so we will hold your questions until the end of the presentation. You can write your questions down during the session and then type them later using the Q&A or the chat. Publishing is generally hard. There are a lot of challenges. Christian publishing may even be harder. You are both a ministry and a business. Donations may not always be there. You have to generate enough cash from your sales to keep yourself not only afloat, but also growing. Our speaker today is Ms. Joyce Mae Manalang. She's the Finance and Supply Chain Director of OMF Literature, one of the largest Christian publishing houses in the Philippines. Thank you so much, Joyce, for making yourself available to be our speaker today. Please take it away.
Thank you, Ramon. Thank you, everyone, for being here. And it's a pleasure to share with you some things that I've learned throughout my experience with the publishing industry. So I entitled my talk today as 1, 2, 3 is as easy as ABC. We hope so. Anyways, as Ramon has mentioned, our industry is really facing big challenges now, and especially for the Christian publishing industry. And one pressing concern is, how do I make my publishing house sustainable? And unfortunately, there is not one answer to that question, but there are tools that can help us hopefully develop solutions to that concern. And so I'm going to share with you some concepts and points that you can learn. Maybe you've heard of these, but hopefully you will get a little something from my talk today. So let's proceed. So there are 3 points that we're going to discuss today, and of course it's also A, B, and C. A is analyze, B, budget, and C, cash management. So let's proceed. What's a financial analysis? It's analyzing financials. No, kidding aside. So if we can read the definition, financial analysis is the process of evaluating businesses to determine whether they're performing well. So financial analysis is used to determine whether an entity is stable, is it solvent, is it liquid, or it also answers the questions that we may have, like, is your company profitable? Is your company sustainable? Or until when will my company survive? Questions like that. And with this, before I proceed, I would like to define two concepts, profitability and sustainability. So if we differentiate the two, profitability is the ability of the company to earn profit. You should not define the word by itself, right? But the ability of the company to generate funds, such that its revenues are higher than its expenses. Whereas sustainability is the ability of the company to earn profit in the long run. So profitability has a short-term focus, while sustainability is more future-looking. Also, Mr. Ramon Rocha's book, I remember, he defined sustainability as the ability of a publishing house or a publishing business to be profitable not only for survival but also for growth. So profitability just looks at how we can survive for the year, but sustainability is making sure that we generate enough funds so that we can grow, we can invest more in capital, we can invest more in our assets, we can invest more in our people, so that the company will grow. So having said that, we have some tools to determine whether a company is profitable or whether it is sustainable. And these are called financial statements. I hope that everyone would have had the chance to look at the financial statements of their companies. No, but there are four types of financial statements. Actually, in one set of financial statements, there are four statements, and these are the income statement, the balance sheet, the statement of cash flows, and the notes. Income statement is your statement of financial performance, as they say, or your profit or loss statement. And this statement shows the company's profitability. Balance sheet, on the other hand, is a statement of financial position, shows a company's sustainability. And statement of cash flows is just the cash basis of your income statement. And lastly, the notes are just explanatory notes to the rest of the financial statements. So if you can have your handouts with you, you'll see there a sample set of financial statements, okay, of JDN Publishing Company. It's a fictitious publishing company, okay? So the first statement there, this one is a profit or loss statement. Here you see the company's sales, expenses, and the company's net income. So if we go through here, net sales is just your sales less all the discounts that you give to your customers. Cost of sales, on the other hand, or some companies describe this as direct costs. This includes our printing costs, all the costs related to producing a book. Okay, and if you subtract that from the net sales, we get the gross margin. Okay, so this gross margin, below that, you deduct all the operating expenses, your indirect expenses, or your fixed cost for some. That's rent, salaries, and you may have other line items in your operating expenses. And you get the net operating income. So net operating income is gross margin minus operating expenses. And other income and expenses, these are where the not so directly relating to the business, like interest income, other gains, forex gains, etc. No? And when we remove that, we get the bottom line. So the profit and loss statement is just performance for a specific period of time. That's how we perform normally for the year. Okay, some would have shorter than that, but normally it's for the year. On the other hand, this is the statement of financial position. Statement of financial position shows a snapshot of your company at a given point in time. Profit or loss is for a given period of time. Balance sheet is at the point of time. So here it shows the cumulative performance of the company for the past, since it began. Okay, so sometimes if you want to know the company's net worth, you look at the balance sheet. Okay, so here you have the assets, so like your cash, receivables, inventories. Non-current assets, these are your assets that are not very liquid, not easily convertible to cash. So like property and equipment, etc. You have your liabilities and your equity. Now your equity, this capital stock is only for companies that have are stock. When you have stock, some companies, like most especially the publishing companies, are non-stock, non-profit. So you wouldn't have this line, but you'll have retained earnings. Retained earnings, if you see the net income here in the income statement, if you add everything from day one, this net income goes to retained earnings. Okay, so this is the cumulative earnings that the company has amassed since it started. So if this is your investment, the capital stock, this is what the company has already earned thus far. And so this is also actually equivalent. This total equity is actually equivalent to the company's net worth. So if you want to see the value of a company, you look at this line item. Okay, total equity. But we won't be discussing the financial statements, but we will discuss how to analyze financial statements. For me, financial statements are just a summary of how you performed for the year or for the past years. So it's a done thing. It's history, But there are still tools that can help us dig into what these numbers mean. Go to my next slide. Peter Drucker said, what gets measured gets managed. So if we learn how to measure, for some, the financial statement is already a measure, but for me, it's still just a summary, you know. Financial ratios, on the other hand, can help us better measure the performance of our company. So there are many financial statement analysis tools, but in the interest of time, I will just share with you ratio analysis and introduce to you, or maybe you're already doing these, some ratios that can help us analyze our financial statements. So let me proceed with the first set of ratios. Profitability ratios. How do you know that your company is profitable? So these ratios measures the ability of the company to generate income, okay? Or we call it the margin ratios. Let's do an example. Gross margin ratio is just computed by gross margin over net sales. Okay, gross margin, if you have calculators with you, you can compute gross margin, which is 400,000 divided by net sales. So 400,000 divided by 1 million, you get, ta-da! So you get 40%. So what does that mean? For each item that I sell, for example, for $10, only 40% of that represents my profit from that item. Meaning, 60% actually goes to the cost. 40% is just what I get to cover for the rest of my expenses. So sometimes if we sell a $10 book, we're thinking, oh, $10, I'll have $10 to cover the rest of my expenses. But actually, no. We only have $4 out of that $10 book, you know, to cover for your other expenses. Okay? This is a very important ratio because it helps you. If it's too low, then you will have smaller room to cover your expenses. But if this is a bit higher, then you'll have more leeway, to cover your operating expenses. This is also very important because it will impact your pricing decision. So you will have to price your products um, in a level where you're comfortable with the margin that you'll get from that price. Okay, so that's gross margin ratio. Next, we have net income ratio. Net income ratio is just net income, 135,000, divided by net sales, 1 million. So you'll get 13.5%, which means that for every item that I sell, 13.5% of that is my income. I think this is a bit high as a net income ratio. Some would be 1% would already be acceptable. It depends on the company. Okay, so after profitability ratios, we're also going to learn about liquidity ratios. Is your company liquid? What does liquid mean? Liquid means the ability to be converted, for an asset to be convertible to cash. So the easier an asset is converted to cash, we're saying it is more liquid. Or it also defines how the company is able to pay its liabilities using current assets. Why do we pay current liabilities using current assets? No, because something is bad already if we need to liquidate our fixed assets just to pay our current liabilities. So our current operations should be able to pay for itself. Okay, so we have two measures there: current ratio and quick ratio. So if we take a look at our financial position or our balance sheet, current ratio is computed as current assets over current liabilities. So current assets is 1.1 million over current liabilities of 325,000. So if you divide that, you'll get 3.38. What does this number mean? This number means that for every dollar of debt, or every peso or whatever currency you have, for every dollar of debt, you have $3.38 to pay it with. Isn't that very nice? You have one debt, you have ample money, $3.38 to pay it with. Now, how about quick ratio? Quick ratio is just similar to current ratio. It's just that we remove inventories. Because when you look at the current assets section of the balance sheet, cash, receivables, inventories, out of these three, these two, cash and receivables, are the more liquid assets, meaning it's easier to convert to cash versus inventories. Inventories could take long, to be converted to cash. So if we remove inventories, so we will do current assets less inventories, so we have 350,000 over current liabilities, 325,000. And we get 1.07. So this again means for every dollar of debt, I have $1 of my liquid assets to pay for my debt. Now, this is an important ratio because if your inventories are significantly high and your quick ratio falls below 1, your current ratio can be more than 1, but your quick ratio is below 1, then there's an issue. Okay? You have a liquidity issue. Okay? So ideally, quick ratios must be greater than 1. We must have ample current assets, liquid assets, to cover our liabilities. So we all hope that we have quick ratios greater than 1. Okay? So let's proceed with the rest of the ratios. Here are efficiency ratios. We're getting more, complex. Efficiency ratios measures the ability of the company to use its assets and liabilities, or like how do we maximize our assets. That's what it measures. So we have these acronyms, DSO, DPO, and DII. What are these? So I did a table and we look at these ratios. DSO is called Days Sales Outstanding. DPO is Days Payable Outstanding, and Days in Inventory is DII. Okay? So Days Sales Outstanding is the number of days that receivables get collected. Meaning, from the time you sold the product up to the time you collect from your customer, or this can be this will approximate your credit terms with your customers. So until you collect them, that's your DSO. Days Payable Outstanding, on the other hand, is on the purchasing side. The number of days before you pay your purchases. And lastly, Days in Inventory is the number of days that inventory remains unsold, meaning from the time it takes for your inventories to stay in your warehouses. That's the days in inventory. Now, I gave you the formula here. We will not be solving everything, but I would want us to try to solve the DSO, or Days Sales Outstanding. So the formula says 365. This means it's for the year. Okay, then therefore your net sales here must also be for the year. You can do this in a monthly or quarterly basis. You just have to change 365 to the number of days that you're covering. Okay, so for here, for our example, it's for the year. 365 divided by net sales over average receivables. So net sales, so this is how we compute for the DSO. 365 over 1 million, which is the net sales in your income statement, and 275,000 is your average receivables. So we just take, how do we get the average receivables? It's just the average of beginning and ending receivables. So it's beginning plus ending divided by 2. So you average them. And you get 275,000. So if we compute for the DSO, it's 100 days. What does this mean? It takes a company to collect its receivables 100 days. It takes them 100 days to collect. Okay? So why do we want to measure that? Because you might have terms with your customers for only 60 days or 90 days. And when we compute for DSO, effectively you're collecting 100 days. Then that means that we have to improve our collection strategies so that we should approximate, okay, the customer, the credit terms. Okay, so that's DSO, DPO, and DII. So you may try to solve them on your own, and I can give you the key answers later on. Okay, so basically the logic is the same with days payables outstanding and days in inventory. Later on, in the last few slides, we will meet these concepts again when I introduce to you the third concept. But before that, we go to letter B. So A, we've analyzed our numbers using ratios that we've discussed. B is budget. So we've all heard of the word budget, I suppose. So for sure, you have different ways of doing budgets. So what I did is just summarize, some points that I learned on how to make budgets. So I did an acronym again. B, buy-in. Buy-in is important because we need to involve everyone who are the key people in the company, to contribute in formulating the budget. Well, does this mean, Joyce, that we have to involve everyone, even up to the rank and file? Well, not necessarily, but I think I suggest even up to the middle management should be involved in crafting the budget of the company. That way, they will have ownership, in the budget that they're crafting. Use historical and projected information. Sometimes when we do our budgets, we only base last year and do a certain percentage, and voila, we have our this year's budget. But it's also important that you know of projected information, meaning we know that there's an oil price hike and expenses will will surely increase. We are anticipating that there's going to be a big project next year, so we have to factor that in also in our budgets. It's not bad to make last year a basis, but we also have to examine our assumptions to make sure that future information are also incorporated in our budget. D, deviations, or variances. We need to understand the variances periodically. So we try, sometimes our budgets are for the year, but it's helpful that we also have monthly budgets, so that we can track our performance better. G is guide. Let's take note also that budget is just a guide. Some would strictly follow the budget. There's nothing wrong with that. But of course, there will be assumptions may change during the year. And so budgets are just guides. E is encourage productivity. That's why I mentioned buy-in earlier, is because if people have ownership, in the targets that they set, then it will encourage productivity more, because this way we will not be setting too high, targets that are unachievable, but targets that can be still challenging, but people can reach them. So we hope that our budgets encourage productivity from our people. And lastly, there's a top-down approach or the bottom-up. It's just a way of crafting the budget. Top-down means you set a sales, you set target sales, and then move down into your profit and loss statement, Meanwhile, bottom up means we want to target net income, and then you work your way up to determine how much sales you need to have in order to reach your target bottom line. So I would prefer the bottom up approach. That way we are sure that we're going to hit the bottom line, that we're going to reach that. Okay, so those are just my points on budget. So we need to move to the next point, which is cash management. So cash, if you will agree with me, is the most, well, aside from all of us people, as the most important asset in our company. I believe cash is a very important asset. So without cash, we wouldn't be able to pay ourselves, right? No, but cash is a very important asset, in our company. And therefore, it's also very important to manage cash. Now, I'm going to introduce to you this. Some of you may have heard of this concept, but I would like to introduce a concept called cash conversion cycle. What is this? Now, remember our ratios earlier. We're going to need them, when we compute for our cash conversion cycle. Cash conversion cycle is, to simplify it, is just the period of time it takes for cash to become cash again. What do I mean? In our company, we buy inventory, right? And then we pay suppliers. Okay? After that, we sell the inventory and then we collect, right? So we buy inventory, we pay our suppliers, we sell the inventory, becomes receivables, and then when we collect that, then it becomes cash. So the period of time, remember earlier, the period of time that we buy our inventory and we sell them, that's the days in inventory, right? That's the warehouse time, time your inventory is in your warehouse. Now, the time for you, when you sell the inventory, it becomes receivables. Up to the time that you collect, that's the days sales outstanding, or our DSO. Okay? The time from the time we buy inventory becomes payable to the time that we pay our suppliers, that's our days payable outstanding. Okay? So this is when cash actually goes out of the company, right? That's the cash out. And this time, this point in time where we're going to collect, that's when cash comes in. So this period is called our cash conversion cycle. The period where cash becomes cash again. Okay? So what's the formula for cash conversion cycle? It's just days in inventory plus days sales outstanding minus days payable outstanding, we get cash conversion cycle. So let's do it on our own. For example, our days in inventory is 90 days. Okay? Our days sales outstanding is 60 days, or our credit terms with our customers. And our credit terms with suppliers, or our days payable outstanding, is 30 days. How many days is our cash conversion cycle? So let's do it on our own. 90 plus 60, so you get 150, minus 30, we get 120 days. This means it takes 120 days for us to wait from the time we cash out and the cash comes back in the company. So why is this important? Why do we have to know this? That means when cash goes out, cash is tied up to an asset, either inventory or receivables. So you have 120 days waiting for that cash to come back to you. So where do we get the money to cover your rent, to cover salaries, and your operating expenses for 3 months. 120 days divided by 4 months, right? 120 divided by 30 days, 4 months. So this means that if our cash conversion cycle is 4 months, we need to have extra funds to cover 4 months worth of operating expenses. That's too high, I think, no? Depending on the company. So the goal actually here is to shorten our cash conversion cycle. Is there a way to shorten them? Yes, no? Because since if we imagine these arrows, if we want to shorten the cash conversion cycle, then we have to shorten DII, shorten DSO, or lengthen DPO to have a very short cash conversion cycle. So here I've identified some points maybe that can help you shorten our cash conversion cycle. So decrease DII, which is a perennial problem maybe of a lot of us in the publishing industry. Leaner inventory. We have to revisit our runs, because inventory is cash in the form of books. So we could not pay people with books, right? So as much as possible, we keep a lean inventory. Well, we revisit our runs. We try to do POD. Those are some solutions to have leaner inventory. And there are a lot more for sure that you can think of to decrease and to have leaner inventory. Also, liquidate old inventories. So if money is tied to, if cash is tied to books or are still in the form of books, if these are already very old, even if we have to sell them below your selling price, or if you have to sell them at cost, you might make the difficult decision to let them go and liquidate them so that we'll have fresh cash. Okay, so that's DII. Decrease DSO, or days sales outstanding. As much as possible, we have to have efficient collection measures so that we stick to the credit terms of our customers. So there are other tools like you age your receivables to make sure that we don't have long outstanding receivables. Also, a suggestion, let your credit terms with your customers be shorter than your supplier terms or your DPO. If we have 60 days if we promise to pay our suppliers 120 days or 90 days, let's make sure that our customer terms or customer credit terms are shorter. This way, we get to collect first before we pay our suppliers. Okay? And lastly, increase DPO. Take advantage of supplier terms. Now, if the suppliers give you 90 days, then let's try to maximize 90 days, if you may, so that you can still, for example, you already have the cash. On the 60th day, you already have the cash. There's an extra 30 days for you before you need to pay your suppliers. Now, that 30 days, you can invest the money and earn some interest from it. So before you pay your suppliers. And lastly, aim to collect, as I've mentioned earlier, aim to collect before your payment is due with your suppliers. So these are just some suggestions to shorten our cash conversion cycle. So I think we can summarize what we've learned so far. So I've discussed 3 points. A is analyze, B, budget, and C is to manage your cash by managing your cash conversion cycle. So I think I'm done, and it's time for questions if you have questions or clarifications.
Thank you very much, Joyce.
Thank you.
Yeah, I'm sure there are a lot of questions out there. Um, I just want to add that in the A analysis, I think it's good to see the trend, to be analyzing, comparing your measurements over the years or over the quarter, over the months, to see where you're going, whether you're going flat or you're going downwards or you're improving. I think it's good to see the trend of where you are, the progress.
Yeah, actually part of the actually one of the things that I before part of financial analysis is also trend analysis,
Mm-hmm.
where you can see your performance year on you plot your performance year on year to see how you are performing.
Yes, very good. Thank you. So we are open for questions. Jean Pastor, I hope, well, you can view the recording again, because I think he was experiencing more of Joyce's beautiful face than the
Sorry.
images. On my screen, you have Joyce's at the corner, so I don't know um, how it is over at your side. Liz, you raised your hands a while ago. Did you have a question?
You're welcome, George. George, is it Georges?
George, yes.
Georges. I hope you picked up a thing or two.
So any question on the A, analysis, on the B, budget, or on cash management? So you might have some questions. Oh, it's clear to George. Thank you, George. Yeah, so it's good to be on top of your financial analysis. I hope if you're working in a publishing house, you have people who are monitoring your performance and that they are able to give you management reports for you to analyze and see where you're going. Liz says, I like the ABC and the CCC concepts. Yes.
Maybe next time I can have it on the board.
Thank you. Maybe next time you could help us understand in details how to draw budgets.
Yeah, that
Maybe
would be
you
an
could say,
entire
yeah.
one topic. Yes.
Well, you have set some guidelines there. Using historical and projected information and examine your assumptions, you said. So in doing your budget, you have to involve everyone, especially the department heads, if you are divided into different departments. And as Joyce said, you need buy-in. And not only looking at the budget of last year, but also what your projections are for the coming year, and what your assumptions are. Yeah. Budget is not only costs, but your sales as well, your sales budget. Now the question is, yeah, I think the more important and the more interesting is the cash management, because that's where publishers really struggle. So how to make sure that you have the right inventory, that your inventory will move fast. Otherwise, you store it for a long, long time.
It's
And,
cash
and
stored in the
that's
warehouse.
cash, storing cash in the form of books. And that's really difficult.
Yeah.
But we thank God that there is the technology is improving, and print on demand is just around the corner. So you'll be able to not store thousands and thousands of books, but just print enough for what you can sell in 6 months, maybe, or just in 1 year. Sean, this is very helpful and memorable. I really appreciated the CCC. Yes.
Thank you.
Thank you, Sean. I think more and more people are now having cash transactions. So the more cash would come in quickly, the better for you, because if you give terms to your customers, uh, sometimes they don't pay, or it takes them a long time to pay. The more cash transactions you have, the better for you, right?
Yeah. Depends on the customers. If you are working with B2B or business to business, then for sure it's difficult. But if you have B2C,
Yes,
business to customer
business
or
to customers.
retail, yeah. So you might want to consider a good mix of both. So you have trade customers and also retail customers.
Yes, because retail customers, you get the cash right away,
Yes, you have cash
and there is no middleman. So get the best of both. You have widest distribution by selling through distributors and retailers. And you also have a way to sell your books directly to your customers, like in book fairs,
like
in
online,
conferences, online
like
selling, yes.
e-commerce.
Yes, online, if that's available in your country. Yeah, you put up book tables at churches, and yeah, sell books directly to your readers. And then, of course, negotiate payments with your suppliers, right? Negotiate payments to your suppliers. And if initially they're giving you 30 days, negotiate for 60. If they're giving you 60 days, negotiate for 90.
Yes.
Especially when you are a good customer to them, you can negotiate. Okay. Any question? I think everyone got the teaching from Joyce very clearly. They don't have any question. Or it's not a problem to you. It's always, of course, a challenge for you to generate enough. Oh, the pricing. You mentioned about gross margin and net income ratio. The key there is how to price your
Yes.
books.
Yes.
Pricing your books not to lose, but pricing your books to earn a profit. And that's a big challenge for many of the publishers.
So when you do price, you do not only take into account your direct costs, but also your operating expenses.
Yeah, that's a challenge because uh, are your readers able to afford the price that you're going to set? If your context is a difficult one, a poor economy, and yeah, how do you price your books such that you cover your expenses and you have profits for growth as well?
Maybe it would help if you'll have a certain mix of books, meaning you sell higher priced ones, but you also have lower priced ones that will cater to your market.
Yes.
An option.
That's what we call sales mix, Joyce.
Yes.
So identify those titles that you can price a little higher than usual. Um, Maybe your premium books, and let them subsidize your ministry books, your gospel tracts.
Actually, you'll be surprised sometimes if you try to test a book in the market and try to price it higher. You might be surprised that people might buy, because if you're too used to pricing it too low, you might not be exploring that market where they are actually willing to pay more.
Yes. And you have to make sure that you're producing quality books, because people appreciate good quality and they're willing to pay. If they see that you're improving your quality, your books are well written, well edited, your covers are nice, your printing, your binding, everything looks nice. I mean, they would appreciate your work and say, I'm willing to pay this for a little higher. So it goes into your pricing, your quality. You have to make sure that you're producing quality books. I was telling one publisher and said, I think you can tell the churches, your customers, that they can support you by buying your books at the right prices, and not always expect your books to be very low in price, because you are not sustainable if you keep on losing. So it's also a way of telling our readers that if they want to see the publishing house flourish, one way of supporting the publishing house is to be able to say, yes, I will buy at the right prices. So yeah, pricing,
Actually, also
analyzing statements.
your discounting strategy, because your selling price less the discounts give you your net sales. So it's also a factor.
Yeah, discounting when you're selling through retailers, or also when you're selling directly.
Yeah.
Mhm. Okay. Okay, I think unless there are any other question, we covered everything, the ABC adequately. Analyzing the budget and the cash management. So thank you very much, Joyce. It's been
Thank you.
a wonderful teaching session on the finance, publishing finance. And thank you everyone for joining us. Thank you for your time. I know that for some of you, this is late afternoon or early evening in Africa. And in Asia, it's evening. It's a sacrifice for Joyce to be up. And we just want to appreciate you for joining us today. Thank you again, Joyce, for your expertise, for your willingness to serve. We thank you on behalf of MAI, on behalf of all our participants. Yes, Jean, of course. Let me just invite our friend from Africa, if you have not registered yet, to our conference, Lit Africa 2019. It's a continent-wide training conference for African Christian writers, editors, publishers, booksellers, designers, scriptwriters, and others working in the publishing industry. That's November 5 to 7 in Accra, Ghana. Please visit the website of MAI, litworld.org, for more details. So if you have not registered, I think we have extended our deadline for registration for you to get the discount up to the end of September, if I'm not mistaken. So yes, the Lord bless all of you, and thank you again for joining us.
Thank you.
Thank you, Joyce. Goodbye for now.
Okay.